The buzzing sentence in the market that we are hearing is, "Sir, when is the big correction coming?" We know that the correction is coming. We know that this time it's going to be a big one. If only you could let us know, when is this likely and to what extent can we expect the correction to be? In today's episode, we will answer exactly this and try and understand exactly where are the valuations. If we consider the Nifty, if we consider the Sensex, if we consider everything that you need to consider as an investor. We'll also see what could be the reasons that the market corrections could get triggered. At least you know the reasons and you'll be able to calculate as to when the corrections will also take shape. More importantly, what should you do if and when? Please keep an eye on the words that I'm saying. If and when this correction happens, what should you do as an investor? Let's try and answer these questions today in this masterclass that deals with market corrections. You're watching the Informed Investor, Third Empire, by research and ranking. Let's get started. Everyone thinks that it is COVID that brought Indian economy to its knees. That's exactly not the case. That it was not COVID that got us to a very, very bad start when we began 2020. I would want you to please see the slide which is coming up on your screen now. And this is a slide that depicts what India has gone through in terms of its GDP growth for the past 10 years or so. Are you able to see this? From the current levels of where we are as a GDP growth, which is around the 9.5% mark, the only recent past in which I can say that this happened was back in 2010, 2011, where the economy had grown by 8.5%. This is the GDP growth I'm saying. Soon after that, the GDP slumped and got to the levels of about 5.2%. It very smartly got back on the growth path to the point that in 2016-2017 fiscal, it recorded a GDP growth of 8.26. But what happened after that was a consistent deceleration that we saw in the GDP growth to the point that before COVID hit us, India was exactly at about 4% GDP growth, lowest ever. And it was at this time that unemployment was at its peak, in fact, the highest in the past 45 years. Private sector investments were at the lowest. And if you were to go back, the consumption expenditure here at this given point in time was indeed shrinking and falling for the first time in many, many decades. Now I hope you get the scene that it was exactly not COVID which got us to the point that we saw the first quarter behave of FY21. The economy itself was sluggish, it was reeling under pressure, and COVID happened to be the double whammy. Why am I saying double whammy? Because it was because of COVID that we saw a phase in the economy where I can recall a number for the month of April 2020 when the net auto sales were zero. You heard me right. The net auto sales was zero in the month of April, and that was the impact that COVID had on all of us. Now I'd want you to see a chart which is appearing on your screen, and this depicts the hit that the Indian economy had in the first quarter of FY 2021. Can you see this? Great. Now, obituaries were written saying that India's economy had gone into a downward spiral and would never be able to revive again in the near time future. Why? Because the GDP growth, as you saw, was already coming down, and with COVID, the first quarter GDP growth that we registered was a minus 24.4%. And this is where I said, most of the pundits said that the game is over for India. But as they say that how bad can it get or how worst can it go? From levels of where we were in Q1, where we had registered this sort of a number of a minus 24.4, things could only get better. As the lockdown was eased, as many cities came back to norms, as we started wearing masks, as you started seeing a lot of informed investor over the period of time, and joining the office duties, the economy gradually got back on track. It was the second quarter that registered a growth of minus 7.4, and this is where the pundit said, well, these are 2 quarters where we've seen a negative GDP growth, and hence, technically speaking, India was in recession. Indeed it was. Only technically, because we knew that the GDP growth was really looking up, especially in Q3, where it happened to go into the positive territory of a 0.5, a minuscule one, though it was very important, and ended the year, the final quarter, at 1.6%. But for the overall year, the net impact that COVID had on us was a minus 7.3%. This is where many experts came and said that there is going to be an alphabet-based recovery, and the alphabets that we kept on hearing were a K-shaped, a W-shaped, a V-shaped recovery. Now I want you to see this graph which is coming up on your screen now. If ever you wanted to draw a V could be a vaccine, could be victory, could be the V-shaped recovery that we are discussing right now. It is exactly what this looks like. Because as we discussed, that in FY21, the markets had declined by minus 7.3. The current estimates for FY22, that is the period that we are at, IMF, RBI, all other agencies agree that India is going to be growing at 9.5%. And if you compare 9.5% to the past quarters or to the past years, this is indeed one of the best GDP growths that India is going to be registering in this given year. Now, we've discussed what happened to the economy in terms of the GDP. Let's discuss what happened to the markets because of COVID and because of other reasons. All right. On March 11, 2020, if I recall the date correctly, WHO had announced that COVID was no longer an epidemic, it was a pandemic. And on March 12th, which is exactly a day after this announcement was made that COVID is a pandemic, I believe Nifty had corrected by more than 900 points on one single day. And it ended the session at 9590 levels. And this was March 12th, 2020. What followed about a week or 2 weeks down the line was when Modi ji came and announced that we are all going into a lockdown as a nation. That date was 23rd. And on that date and the time thereabouts, the Nifty had registered the sharpest decline to levels of about 7,500. Very, not so long ago in January, Nifty was at levels of about 12,000. For it to go from 12,000 to 7,500 odd levels meant that it had declined by 38 to 40% in a very short period of time. And this is coming on the back of the weak economic growth that we had, and hence everything was looking very, very gloomy for any given investor. Now, as I say, that we Indians enjoy watching cinema, isn't it? So this was pretty much the story before the interval. Because after the interval, whatever picture that we saw or are seeing is just another fairy tale. Why am I calling it an interval? Because when the lockdown were eased, when cities came back to the norms, this is the story after. And in this story, we saw the indices go up from levels of 7,500 to levels of 18,000. You are a witness to what is happening to the markets. If you put it arithmetically or mathematically, this is a growth of about 140%. I'm not talking about a stock here or a stock there. I'm talking about Nifty 50 stocks of the indices taking the growth to levels of what 140% in a matter of about 18 to 19 months. That is the seismic growth that we've had, and the markets are just unrelenting. Well, you must be asking us, what has led to this sharp recovery, or why is it that we've seen the markets go up from levels of 7,500 to levels of 18,000? Because if those reasons hold true, and if it is not a fad, if it is not a fantasy that all of us are having, then indeed there must be something concrete because of which the markets have gone up. If the reasons are valid today, they are also going to be valid tomorrow. If the reasons are today seen as the building blocks, then please believe me, the future also holds bright. But what are these reasons? I thank my colleagues. I thank Merlin, my colleague here. And she's been a tremendous help for me to be able to put everything that you're going to be seeing today. There are 14 points that I've mentioned. 14. These are the structural building blocks on which the FIIs have been investing in India as well. FIIs do their own due diligence, and only when they're convinced that a growth story exists, they invest. But what is it that they saw that you and I perhaps saw less or could not see? These are the 14 reasons, but as I say, a book has a title. And what follows in the book is a lot of story. The title of the book that I'm going to be reading right now to you is India is the most compelling long-term growth stories in the emerging markets. This is the title of the book. But why? Why are FIIs reading this book? Well, this is not a book that exists, but this is the way that India is growing and India is seen. Reason number one. The exuberance is very, very justified because there are a slew of bold reforms that are being announced by the center. The government is so responding, the government is so on the toes, and the recent examples, if I was to quote you about giving the relief to the telecom sector, announcing the PLI for textiles, announcing the PLI for automobiles, if there is a sector that needs a help, the government is out there to make sure that the sector which is reeling under pressure is relieved and is able to come back and stand on its feet. There is strong liquidity, and this is reason number two. Liquidity that has been infused by the central bank, and thanks to the measures that they've taken of keeping the interest rates under check. Today, the money in the system is plush. The liquidity exists. This is the reason why corporates are able to announce capex programs. This is the why corporates are able to deleverage their balance sheets and pay the debts that are there on their books. This is the reason why you see an increase in the discretionary consumer spending. Reason number three. Well, I just said that interest rates are very, very benign, and RBI did its part to help recover and bring the nascent recovery on its feet again. Reason number four is basically the macroeconomic cues that India is taking. Because if you see the GST collections, they've been the highest till now. If you look at the uptick of the PMI in services or PMI in manufacturing, they continue to scale higher numbers month after month. The IIP data is something that you can take heart. The young demographic dividend that we have as of now for 1.3 billion population is just not limited to people in number terms, but people who are consumers as well. And not ordinary consumers, but consumers whose wages, whose salaries are going up, and they are showing that pocket, which is that deep when they want to spend. The next reason is, of course, the introduction of the Robinhood investors. And these are the people who helped create that IPO frenzy. If you remember, we did an episode on that as well. These are the people who are participating and helping the domestic part of the story of investing in the markets always healthy and alive. Well, they chimed in big time in 2020. They're chiming in now as well because there is a phenomena that they feel they're suffering from. And that phenomenon is known as FOMO, the fear of missing out. If you talk about the banking terms, and this was the parameter that was used by Moody's when it upgraded India, the banking sector was considered at the core, and for the banking sector, solvency in the financial system has strengthened. If you look at the credit conditions, well, they've improved drastically and look to be sustainable for the near-term future as well. If you look at the overall reductions that the banks have been able to do to the legacy problem assets, well, the NPAs are less worrisome, but the woes still continue. Economic activity is picking across all the sectors, and there is a broad participation from every given sector. These are the financial reasons and why the recovery has been liked by many, including the FIIs. To the seventh reason on why I feel that everybody is excited about Team India. If you heard Piyush ji, if you heard Nirmala Sitharaman ji, if you heard Subramaniam ji, all of them said that now with the capex investments being done by the corporates, now with economic activity coming back on track, the question now is when the productivity catch-up will happen, because that will define the next league of growth for us. Number 8, new business registrations is something that I covered in the recent past, and it said that new business registrations have been so rampant that if you were to compare agri and manufacturing sector from 2019 till 2021, they've exactly doubled in terms of the new businesses that have registered. Supply chain shifts have been seen in favor of India. And this is where India's relation, which is the next point that I come, which is point number 10, with EU and US have become much more stronger, and there is a gradual shift in the supply chain partners that these nations are preferring. Number 11 is the reason that tourism and services is back, and so is employment. Number 12, the housing market seems to have found its own mojo now. And when I'm saying mojo, I mean that the interest rates are benign, they are the lowest in many, many decades, that the stamp duty is the lowest, that every person has plush money, liquidity with him or her, and this is the reason why they are expecting to buy that new home very soon. This is the reason why housing is on an uptick. Indian households are coming out of the Delta wave, as they say, the strain which is affecting the entire world, with a lot of bold but very, very conducive sort of savings. In the episode that I said that 665 billion US dollars have been added to Indian household savings. That is phenomenal for FY 2021. More importantly, income levels have been expanding to the point that today the discretionary spending part of the growth is much, much more evident. These are the structural reasons, and I'm not saying that all of these reasons played out at once. There was a cascading effect. There was an avalanche of good news that kept on coming month after month, week after week, stimulus after stimulus, which led to the investors feeling that there is a lack of bad news, if not the good news, which was working in their favor. And that is why the markets kept on going from levels of 7,500 to 10,000 to 11,000 to 15,000 to 17,000 to 18,000 levels. Now, there is a dichotomy that exists, because if you ask an equity investor, they'll say, can you please bring back 2021 FY again? If you ask an economist, he'll say, God, this year never comes back again. And the dichotomy is that in a year when the GDP degrew or declined by minus 7.3, the indices actually went up by 72%. I'm talking about Nifty. And this is the dichotomy that existed, where GDP went down, but indices went up. Now, in just a little over 8 months, if I'm not wrong, it was basically September 24th, that Sensex reported 60,000 mark. Sensex in January 2021 was at 50,000. In 8 months, Sensex added 10,000 points. Can you beat that? Now, this is why the talk of the town is that things have gotten very, very expensive. That now, everybody, including me, we are all feeling that things are expensive. And this is where the talk of the town is, that the correction is around the corner. We are going to be discussing this particular part, but for that, I want you to see how expensive are the valuations, okay? We said in Informed Investor series that we will talk about markets, but we will talk with numbers. Without data, we will not present anything to you. Now, please look at the screens which are coming. On your screen is the market cap to the GDP ratio. Now, please see this, and it says that in FY20, the market cap to GDP was 55. And if you were to see market cap to GDP, which is to say that you are calculating the market cap to GDP ratio by the market cap of all the listed companies as a numerator and GDP as the denominator. If you were to do this, then for FY21, this has improved to 103. And for FY22, we expect market cap to GDP to be 119. Please keep in mind that the 15-year median ratio of the Buffett indicator, this is known as the Buffett indicator, is 79. We are at 103, 105. So this is surely indicating that we are in the expensive zone. Many of the articles have covered this particular story and have said that market cap to GDP is very, very high. Look at the second graph which is coming up on your screen now. This graph is profit to the GDP. Now this is another ratio that if you see in FY20 was at its lowest of 1.5. Come FY21, this is improved to 2.9 and it's expected to sharply go up. This is the good news, to levels of 3.4. Why good? Because now many of the companies like Paytm, like Nykaa, like Policy Bazaar, which were contributing to the GDP earlier but were not calculated for the market cap terms, will now be counted because they are going to be listed. And listed companies such as Zomato, which were contributing to the GDP, were not being taken into calculations earlier. But now with them getting listed, the the profit to GDP will basically go up. Now this looks exciting, to be honest, but you all understand a reason and a number which is known as PE. There is a lot of knowledge and awareness around PE, the trailing multiple, the forward multiple. They say the higher the PE, the more expensive the market is. Well, if I was to put the PE of Nifty to you, then a 10-year Nifty PE is basically 20 times, which is 20x. And a 15-year Nifty PE, the average is 19 times. Please keep in mind that a 10-year Nifty PE is 20 times and a 15-year Nifty PE is 19 times. Where are we now? Look at this graph which is appearing, which is titled Nifty PE. For the year FY22, which is another 5 months from now, the expected PE, the multiple that we are expecting, is going to be 24.7. Why 24.7? Because for FY22, the EPS that is expected of Nifty is going to be 730. 730 is actually a growth over 540, the EPS for FY21. Now the growth in earnings between FY21 and 22 is expected to be 35%. And that is why at levels of our calculations of Nifty being at 18,044, the forward multiple that we're getting is 24.7. Fast forward this to about a year, because in another 5 months time, nobody will be talking about FY22. This will be history. Everybody will be interested in investing in FY23. And FY23 is just 5 months away. And as you step into FY23, the EPS growth that is expected is 840. So from 730 levels, the EPS is expected to go to 840. Please see this. This is going to appear on your screen as I speak now. What that means is that the forward multiple that you'll be getting is 21.5 for FY23. For FY24, if we consider an EPS of 935, which is another 11% growth in earnings, then we expect the forward multiple to be 19.3 times FY24 earnings. Now, this is where people are saying, well, if you were to compare it with the historical average of a 10-year being 20 and a 15-year being 19 times, still FY23 available at 21.5 times is expensive, and FY22, well, it's just 5 months, so I won't talk about that. That is where people are saying that the markets are expensive. But there is one thing that you have to keep in mind, that these so-called benchmarks of a 10-year, 15-year forward multiple of being 19 and 20 will basically get re-rated. They will get re-rated because you're looking at a very, very low interest rate regime, and this basically implies a higher NPV. Because of this, there is going to be a probable re-rating of the averages of a 19 and a 20x, which is the forward earnings. All right. So now you know, specifically speaking, why people are saying that the market valuations appear very, very stretched. Now, let's look at the realistic numbers which are coming from the market, where people are saying that the market is expensive. Now, I go back and talk about Avendus Capital Public Markets. This is India's biggest hedge fund manager. Avendus says that the current bull markets, according to their quantitative modeling, are expected to correct by 15 to 20% over the next 6 months. If you go and listen to what Nomura is saying, Nomura said that they are changing their own grading on India's equities. They're downgrading it from an overweight to a neutral position. Purely basis the markets being very, very expensive, purely basis the valuations in a very expensive zone. If you listen to UBS, UBS goes on to say that India has become unattractive due to extremely expensive market valuations. If you were to consider what Morgan Stanley says that they are downgrading domestic equities, Indian equities, from a position of overweight to equal weight. Now, if you read in between the lines, then Avendus is saying that another 12 months from this date, which is probably the November that they're referring to, they're still expecting the markets to go up by 10 to 15%. But in the interim, while the next 12 months play out, they're expecting the markets to correct significantly as well. If you were to listen to what JM Financial Outlook says, they say that the current price to book of the market at 4.3 is exactly 20% higher than the 5-year average. JM also says that 1 year forward multiple is now available at a premium of approximately 24%. JM Financial goes on to say that the market will be range bound and will see a lower end of 16,500 and a higher end of 18,500, but all these levels will basically hold true till the next year. If you were to listen to Marathon Trends, then Marathon Trends says that the inflation concerns will weigh the most, not because things will get expensive, but because the demand will basically go up and the supply chain will get affected. This is where inflation will come and hit below the belt. Like Avendus, Marathon is also saying that the market would be range bound and will see a lower of about 16,000 and higher of about 19,000 levels. Now, you heard the levels from many people, and many people believe that the correction is due, it will be coming, but it won't be parabolic in nature. It won't be the oscillating market correction that you saw in the past. All right? Now, that gets me to the topic, should you be worried about the market corrections? This is why you're watching Informed Investor Masterclass. If I say no, that would do injustice to you, because you want to know why you should not be worried if such a correction comes, because the writing is pretty much on the wall that the correction may happen, and may happen to the levels that I just quoted. But what should you do as an investor, and should you be worried? Well, in my mind, there are 4 reasons why you should not worry. There could be other reasons as well, but I see these 4 reasons as to why you should not worry. Now, these are the 4 reasons. You can make a note as well, but this is what you need to keep in mind. Reason number 1. Corrections and crashes happen, and they happen fairly frequently. This is not something new. Well, if you are an investor, then you can't avoid corrections and cycles of bear and bull markets. Because as an investor, you've chosen to be in an asset class which has these volatilities from time to time. And corrections are part and parcel of being an investor. Now, you may be thinking that if such correction is bound to happen, then why don't you basically sell something and then buy it when the levels are at the lowest? Well, this is where you will get it wrong. You will absolutely get it wrong, because you will end up selling at the lowest and buying at the highest. You can't time the markets. So what you can do is to allow this correction to play out, is for allow this time to pass through. As I say, that this too shall pass. There is a very interesting study that my colleague passed on to me, and this study says that if you were to take a 20-year period, and in the 20-year period you were to take the 10 best days, if you were to subtract these 10 days and then see the returns that you will get, then your returns will exactly be half. 10 days out of 7,300 days. If you miss, your returns will be exactly half. I ask you a question. Do you know, can you forecast, can you tell me what are the 10 best days in the next 20 years? Because the answer from your side would be, you cannot. Even I cannot. Nobody can. So, rather than worrying about the correction playing out, please stay invested. Morgan Stanley says that in the past 25 years that we've been, this market for the past 25 years has gone through 4 bear phases. And all the 4 bear markets have been a trigger from global context. The first that I speak, and this is the past 25 years, so don't get me wrong. The first bear market was, or the bear correction that happened was 97-98. This was largely due to the Asian financial crisis. And this was preceded by the Russian debt default. The second bear market was 2001. This is where the dot-com bubble had burst. The third was 2008-2009, and this was the global financial crisis. The fourth is the bear correction that we saw recently in 2020 because of COVID. Morgan Stanley also says that India has seen in the 3 decades 6 bull phases or bull markets. The current bull market that we are is the 6th one that Morgan Stanley is referring to. Now, the average duration of a bull market has been 72 weeks. We are currently in the 64th week. So, and also keep in mind that India has outperformed all emerging markets by a handsome number, and our outperformance has been 52%. This time, it is 23 for others. That brings me to the second reason why I feel that you should not worry about the market corrections. Market corrections can best be described as the best buying opportunities for you. Don't get me wrong, but some of the most successful investors have made some of the best investments when there have been market corrections and crashes. These are the times when the best of the quality businesses are available to you at a great discount. I rewind a story that played out in my own office, and a colleague of mine said that, can you imagine the March-April of 2020 when a Bajaj Finance was available to you at less than 2,000 rupees a share? Ask yourself the question, has anything changed worse regarding the company's future? And every time you'll get the answer no, because the company's prices are getting affected by the markets which are falling, and as soon as the sentiments come back, the price of this given company shall too. So most of the successful investors wait for such opportunities where they invest. The third reason where I feel that you should not worry or you need not worry is that recoveries are often quick. I just had a COVID jab, and I can relate this to the COVID jab that I took of Covishield. The fear that I had in getting to that particular day's hospital jab procedure and the anxiety that I lived through was far much more than the actual pain that I had when the jab was given to me. In a similar sense, you and I are worrying so much about the market correction and the crash that we are forgetting to invest as we should. And whenever that crash or correction happens, please believe me, it'll come and go and you wouldn't even notice. Keep this in mind, that recoveries are often quick. You never know when is the next correction going to happen. Will it take months for whatever we are discussing today for that meaningful correction to take place? Because I cannot predict, neither can you. So why are you worrying? The fourth reason that you should not really be panicked is that we've just seen a recession. There is no recession coming upon us immediately now. Seldom has it happened in the history that in a matter of 18 months we've seen two recessions. We just saw a recession, right? When I said technically speaking, Q1 and Q2 of FY21 were a minus 24 and a minus 7 something. And that technically meant that we were in a recession. But now, please believe me, that companies are flush with liquidity today. Please believe me that the government is running full throttle, fifth gear on all the reforms. This is not when a recession will happen. This is exactly not the time. So if it is not a recession, then it's a correction. If it's a correction, you should not worry. Now, that brings me to the $1 million question, and this is where we end the episode today. What should I do? This is what you are asking me, right? You've seen the markets, you've seen the valuations, you've seen the experts, you've seen the levels, you've seen the reasons why I'm saying you should not worry. You're asking me, what should I do? Do the 4 things. Number 1, please don't make any big moves. Please don't do that. Please do not try and time the market, because this is where you'll end up selling at the lowest, probably because you don't even know what is low. Number 2, focus on the long-term asset allocation, and that's something that you should always keep in mind. It's very boring to speak about that, but please believe me, it plays out and pays a lot of dividends for you. Not the dividends as in dividends, but dividends as in returns that you get. Invest in a staggered manner. If you're sitting on a pile of cash, please start deploying that money, because you and I really don't know when this correction will happen. Even if it happens, it'll give you an opportunity to enter at prices which will only favor you, not destroy you. And if a correction happens, a significant one, you know what to do, because quality businesses are not accessible that often at that low prices. If at all there is an opportunity, grab it with both hands. I hope we answered all your questions in this masterclass. I hope now you are a little less anxious than what you were at the beginning of the episode. I know that for this episode to play out, it would mean that a lot of your questions are getting answered. But nevertheless, if there are still some questions that you have, we are always here. We are always here to hold you, to guide you, to do whatever we can, because this is a community and a family that we've built of informed investors who are investing basis knowledge and awareness, not basis skeptical, WhatsApp rumors that are floating around. I hope you do watch this episode and make notes and become an informed and an insightful investor. Wishing you and your family and your loved ones the great and the best of the health ahead and the wealth as well. This is Sanjeev Anand signing off. Till we meet again, take care. Goodbye.